Hello and welcome back to the Market Lens. This is our 20th edition and we're very excited to continue providing this market commentary to both our American Portfolios affiliates as well as anyone who wants to tune in. 2022 has been a crazy ride and I'm thankful to have Cliff Walsh, AP CIO, by my side the whole way. At the Market Lens, we try and look at a wide variety of topics, but recently it's been very difficult to deviate from the Fed and the rate hike cycle. Let's try this here today.
We can try, Sam, but it's really hard to avoid talking about the Fed at this point in the cycle.
Yeah, I know. So for this news or noise segment, you can't say Fed at all.
Consider it done. We'll bet $1.
Deal. So while we're on the subject, some are claiming that the US dollar is losing its reserve currency status and the conflict in the Ukraine is accelerating it. Do you think this is news or noise?
It's news, but it's long-term news. Right now I think it's just noise. So I guess both, based on the timing.
Okay, so the good old-fashioned hedge, I like it. Can you elaborate a little bit?
The global economy is dollar-centric. It will be for a long time, but I do expect it to diminish in its dominance in the years to come. With the rise of cryptocurrency and the use of dollar sanctions, which is basically the dollar weaponized, and we've seen that with Russia recently, countries are going to want to de-risk. I would expect over time, we'll see China let its currency float more. You can't be a reserve currency, if you peg to the reserve currency. So I think China will become more of a global currency player. We should see that grow in global usage, as will the euro. I think companies and countries are going to want more options. We saw Russia very recently pay their debts in rubles. It was dollar-denominated debt, but they were forced to pay in rubles because they didn't have any other options, because they were cut out of the global, financial system. So I think as bond maturities roll over, you're going to see new terms and probably more diversification for a currency.
Yeah, so this conflict definitely seems to have wide-ranging global impacts, but let's dig a little bit deeper into the specific impacts on the U.S. economy. What are those impacts?
I think you'll see the U.S. dollar purchasing power drop because of less demand, obviously. You're going to see imports and overseas travel become more expensive, probably see higher interest rates because you're going to want to attract more capital. And I think you're going to see negative for the financial markets in general. On the plus side, I think you're going to see more manufacturing at home and should see more manufacturing employment.
Okay, what do you think the time frame is for this for these events to take place?
I think it's tough to say. I think the dollar will probably be pretty strong this year with interest rates. I almost said the word. I expect it to be a slow deterioration over years and years. I think that what's going to happen is you'll have events like Ukraine and Russia that will accelerate and then it'll go sideways and you'll accelerate or have these stair-step functions that take place with the dollar becoming less and less the reserve currency, but it's going to take a long time.
Okay.
So how did I do?
Pretty good. I almost did it, but not fully. So let's zoom directly in now to the stock market cycle. A little bit different than what we've been discussing, but a lot of advisors out there are asking after this recent rally, are we in a bull or bear market? What do you think?
I don't get too crazy about technical terms. Are we in a bear or bull market? The market's down 19%, so it's not 20, so it's not a bear market. I look at it this way. Is investment capital at significant risk or is it relatively safe? And I think it's hard to say that equity capital is anything but at risk right now. Market valuations are still pretty high, depending on the sector. We've got growth decelerating and inflation is squeezing profit margins. You're seeing earnings expectations come down. You're seeing global macro forecasts come down, and the Fed is set to hike rates more aggressively. That was the last segment, so I feel like I did not violate our dollar bet. The Fed is looking to reduce the balance sheet by a little bit less than $100 billion a month, and what's my favorite chart over the past few years?
Yeah, so it's the S&P 500 correlation to the total assets on the Fed balance sheet. We've shown it at every single presentation or webinar we've really ever done, and the correlation's pretty shocking.
Correct. So, the market's overvalued, earnings are declining, yield curve is inverting, it's signaling recession. We've seen, the tens invert against the intermediate portion of the curve and, flirted with the two tens and twos, signaling recession. The Fed's not only raising the cost of capital to further slow economic activity and M&A, but they're taking away that free money that was, gone to speculating into the equity markets. If you look at the S&P's rise as the balance sheet is expanded, we should all be concerned about what happens as they tighten and reduce the size of the balance sheet. Also, we need to realize that so-called bear markets have massive rallies at times. So just looking at whatever this recent bounce was, 10, 11%, and saying that the coast is clear, I think is very poor risk management in my view. I didn't even mention Russia, the risk of default, the shock waves that we could see from that.
Okay, what about the technicals? Do they matter, but do they matter at all? Do you think we'll make lower lows, or do we even care?
I think there are a lot of different participants in the market, and technicals matter to a lot of the algorithms and things like that. So I think it is important, and I think again the technicals are flashing risk. We're seeing market breadth be pretty weak. The market's been bouncing back and forth above and below moving averages. Right now below. Maybe we've worked off those overbought conditions, and technicals will bounce back, but the cyclicals have been weak. Defensives have been strong. They're making new highs in some areas. Some areas have been beaten up and maybe attractive to buyers, but I think it's probably too soon. As far as we're concerned, we're going to wait for more hikes, more balance sheet reduction, more blood in the streets, as they say, before we get too aggressive in terms of adding equity. Maybe you could speculate short term about certain technical measures, but for the most part, long-term capital getting put to work, we're going to wait on that.
Thanks, Cliff. We'll keep that long-term frame of mind when managing these portfolios. So thank you, everyone who's joined. Don't forget about the American Portfolios National Conference, Connections 2022, set for Mohegan Sun in Connecticut, May 18th through 20th, and you can register at connectionsap.com. We hope this is letting you see 2020. Take care.